Everyone knows that interest rates are finally on the rise. But what you may not realize is what's going on under the covers. What's happening to the bond market as these interest rates rise? Do you realize that there's an inverse relationship between interest rates and bond prices? Today we're going to do a deep dive on what this means for you. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel. And don't forget to hit that bell to be notified when we upload new videos twice every single week. So let's start at the beginning. What the heck is an inverse relationship, and how is there one between interest rates and bond prices?
Well, it's real simple. When the interest rates rise, the value of the bond or the price of the bond goes down. And when interest rates go down, the value or the price of the bond goes up. Now, in and of itself, it may not mean a whole heck of a lot to the average investor, because if you're holding the bond to duration or till the end of the bond period, there's no problem. If you bought a 4% bond and interest rates went up to 5%, you'll still collect your 4% at maturity when the bond matures. The problem is when you're either renewing rates or exchanging bonds. That's where the problem comes into play.
Leave us a comment down below. Do you have bonds incorporated in your portfolio? Now, there are three main risks with this inverse relationship. The first is interest rate risk.
Interest rate risk really comes into play if you need to sell your bond before maturity. If you need to sell your bond before maturity and interest rates have risen, the value of your bond may have gone down, and consequently, you'll receive less than you were supposed to receive. You will lose money.
Now, risk typically isn't associated with bonds as they're considered a safe investment. But as we see here with this inverse relationship and rising interest rates, it can leave you exposed. Now, this could also be a little bit of an issue because bonds are relatively liquid. If it comes down to it and it's between selling your actual investments, stocks, real estate, or mutual funds, it may make more sense to sell your bond because it's the most liquid.
But the point is this: you have to recognize the fact that bonds are not risk-free.
The second issue that could arise between this inverse relationship of interest rates and bonds is opportunity cost.
And basically what that means is you might have better opportunities with higher interest rates, meaning that savings accounts, CDs, annuities, or newer bonds might have higher interest rates than the existing bonds that you hold, making the value of your bonds worth a little bit less.
Now, the problem arises in this case when you want to sell your bonds, liquidate them because they have a low interest rate. You can make more money, more interest somewhere else. So let's get the bonds out of here. We could get a better opportunity somewhere else. But what happens is we have to sell those bonds. You can't redeem the bonds before the maturity date, so you have to sell them on the open market. But with that, they have a lower market value, so you could incur a double loss in a sense. That brings us to our third and final issue with this inverse relationship, and that is portfolio volatility.
Bonds tend to be more stable than other investments, such as stocks and maybe even mutual funds. And consequently, they're an ideal candidate for diversification of portfolios and risk management.
What this means in plain English is when you have a riskier portfolio full of real estate, stocks, and mutual funds, oftentimes advisors will incorporate bonds into the portfolio to stabilize and make sure you're not losing all of your money or all of your money is not at risk.
But here's the problem. During volatile interest rate environments, when the bond interest rates rise, again, because of the inverse relationship, the value goes down. And that introduces risk to an asset that you may have considered to be less risky.
Most people believe that bonds are a safe investment, meaning you're not going to lose money in bonds. And that holds true if you hold the bond to maturity for the full duration. However, if you do need to liquidate those bonds early before the time of maturity, it may have an adverse effect on your overall portfolio.
Here's the point. Fluctuation in bond interest rates can have an adverse effect on your overall portfolio performance.
Check out our next video where we do a deep dive on what this means and how you can combat this inverse relationship between interest rates and bond prices. If you like this video, be sure to check out these two. We picked them out special for you. If you'd like to learn more about our process, check out our website at tier1capital.com.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.